All right, let's talk about AMC Networks. Their third quarter earnings call was, well, it was a head-scratcher. You've got these headline numbers pulling in completely different directions, and it really left the market scratching its head. So let's jump right in and look at the data.
So right off the bat, you can see the problem. On one hand, you've got this huge 470% beat on GAAP earnings per share. I mean, that looks amazing, right? But then you look at adjusted EPS, the number that's supposed to show the actual health of the business, and it's a 42% miss. And yeah, revenue beat by a little bit, but that's really just noise. It doesn't tell us what's actually going on under the hood.
So this really brings us to the big question, the one everyone was asking all day. Was this a good quarter or a bad one? I mean, which number do you believe? Is this a turnaround story, or is the company in serious trouble? Well, as you're about to see, the answer is complicated.
Okay, so here's the breakdown of those two competing stories. That massive GAAP beat, it was all driven by, below-the-line accounting stuff, one-time items. It's not from the actual business of making and selling shows. The adjusted EPS miss, though, that reflects the core, day-to-day operations, and it shows that profitability is really getting squeezed. The takeaway here is crystal clear. You have to ignore the flashy headline and dig deeper.
So to really get what's going on, we have to look at the massive strategic pivot they're in the middle of. Management is basically steering this giant ship away from the old, declining world of linear cable TV, and they're going full steam ahead into streaming. This shift explains everything.
So let's look at where the money is coming from right now. As you can see, a huge chunk, 65% of their domestic revenue, comes from subscriptions. Now that's a mix of both the old-school cable fees and the new streaming subscriptions. Advertising is still a piece of the pie, for sure, but it's really clear that subscriptions are the engine of this company now.
But here's where things get really interesting and, frankly, a little painful. Look at the year-over-year changes. Advertising revenue, down over 17%. Ouch. Content licensing, down almost 27%. Double ouch. But then you look at subscriptions, and it's flat. Zero change. Now wait a minute. How is that possible? We all know people are cutting the cord, so how can that be flat?
And this is the hidden story. That flat subscription line is actually a tug of war between two massive forces. On one side, you have the traditional cable business, which dropped 13%. But on the other side, streaming revenues surged 14%. For the very first time, their streaming growth was big enough to completely cancel out the linear decline. This is it. This is the inflection point management has been working towards.
And the CEO, Kristin Dolan, she made sure everyone on the call understood this. She called it a key milestone in their transformation. The message they're sending is loud and clear. We're not just a cable company anymore. We are a streaming and content company that just so happens to still have this legacy business attached to it.
So how are they actually making this happen? Well, their strategy isn't to go head-to-head with the big guys like Netflix or Disney+. No way. Instead, they're taking what you might call a wholesale approach. It's all about partnerships. They're bundling AMC Plus into deals with DirecTV, licensing some shows to Netflix to get in front of more eyeballs, creating new bundles on Amazon Prime. They're even pushing their free channels on Roku and Samsung. The game here isn't to be the biggest, it's to be everywhere.
Okay, with all this change going on, the old ways of looking at the company, like operating margins, they're getting kind of messy and confusing. So management has basically told investors, look, here is our new North Star. This is the one number we want you to judge us on while we navigate this transition.
And that number is $250 million. That's their target for full-year free cash flow. They've reaffirmed it. They'd previously increased it. This is the target. More than anything else, this is what they're solving for. They're telling the market loud and clear. Right now, for us, cash is king.
But focusing so hard on cash means making a trade-off, and they were really open about this in the Q&A. Basically, they are willing to let their profit margins get squeezed for a while, as long as it helps them hit that free cash flow number. And how are they doing it? By being super disciplined on what they spend on new shows, and by making sure every piece of content they own is working its trail off across every platform possible.
So you've got this complicated story, right? Profits are down, but cash flow is strong. How on earth did the market react to that? Well, pretty much with total confusion. And that led to a really wild day of trading.
And this chart of the trading day really tells the tale. In the morning, the stock tanks, down almost 4%. That's the computers and the early traders reacting to that ugly adjusted EPS myth. But then, as the earnings call went on and management started telling that free cash flow story, the narrative started to sink in. The stock did a complete 180 and actually rallied to close the day UP almost 4%, a total whipsaw session.
And the analysts on Wall Street, they were just as divided. You had one camp that couldn't see past the earnings miss and that big drop in ad revenue, but then you had another, smaller camp that was a bit more optimistic, pointing to that streaming progress as a good sign. It really all boils down to one fundamental question. Is the strong cash flow story enough to outweigh the fact that their main legacy business is slowly fading away?
All right, so with Q3 now behind us, it's time for the next call. We're going to take everything we learned from this quarter, listen to what management said, and give you our take on what to expect when they report again.
So the big question is, where does AMCX stock go from here? Is this a classic value trap where a cheap stock just gets cheaper? Or is this the ground floor of a real turnaround story?
Here's our call for Q4. We're expecting another slight miss on revenue and probably another miss on adjusted EPS. Our thinking is pretty simple. Those headwinds from the dying cable business are still just a little bit stronger than the tailwinds from their growing streaming business, and that's going to keep pressure on their margins. For the stock price, we think that means it's going to be pretty much range-bound. It's stuck. You've got a floor underneath it thanks to that strong free cash flow, but there's a ceiling above it because of the fear about that linear decline.
So with all that in mind, we're giving the stock a market perform rating. Look, management has a clear, smart strategy focused on cash, and that $250 million target really does put a floor under the stock. But the risks here are still really high. For us to get more bullish and upgrade this thing, we need to see proof that streaming growth can do more than just tread water. It needs to accelerate and truly overpower the linear decline. Until we see that, the headwinds in this industry are just too strong to ignore.
This is not financial advice.